And this is the one where you get to learn a little bit about title work. And today, have a special guest. His name is Matt Anderson. He is the owner of Republic Title, a.k.a. Summer Sausage, and he is going to explain kind of what their role is in the title world, in the mortgage process, right? What they're doing while we're doing our side of things. So, Matt, we get that kind of a question all the time. Hey, what are all these fees? What's this title company thing? I don't understand. What do they do? So what's your guys' kind of role? Like, what are you doing in the background while we're doing our loan piece on the credit side?
Great question, because for the last 30 years, anytime anybody has ever asked me what I do for a living, I say I sell insurance, because we essentially sell title insurance, but you tell somebody you work at a title company or own a title company. I'm
going to put this down here so I can hear you better. There we go.
They don't know exactly what it is you do.
Yep.
So we serve as a third-party intermediary between all parties in the transaction. So you have buyer, seller, lender.
Right.
And somebody has to be an independent source of conglomeration.
Right. So kind of a go-between.
A go-between. But our main duty is to make sure that the purchaser has a first and best. The lender has a first and best lien position, and that the purchaser has a bona fide title.
Right. So we close. There's nothing hanging out there that's going to cause a problem for the buyer that has to pay something off, or we're in trouble as a lender, right?
Right.
Meaning, if something were to happen to that buyer, they stop making payments, we're there. We're in first position. We don't have a bunch of other stuff hanging out there.
Right. So just to take you through the whole process, you get a buyer, you do a loan application, you typically order your title and your appraisal at the same time, and title's technically the term for your title commitment, and that's our commitment to insure the property. So you engage us through a new title order, and then at that point, we review your contract, we review the buyers, make sure we have all the information. I know sometimes you'll get an email back saying, we need additional information. And at that point, we send out notices to both agents, if there are agents in the transaction, and we order our title exam through an independent examiner, or somebody on our staff, if it's a local county, will do that themselves.
Right, and they go to the recorder's office, pull documents and stuff like that. Is that right?
We actually search multiple offices. It starts in the auditor.
Right.
And most of the auditors, it's online, so you're not physically anymore going to the auditor's office like the old days where you have to go look at microfiche. Starts at the auditor's office, and you create your chain of title starting there. So you find out the ownership, verify the legal description, whether it's a brief legal or you got multiple parcels, and then you work your way back. On a purchase, we go back 42 years. So you're going to work your chain of title, buyer, seller, buyer, seller, buyer, seller, all the way back through those 42 years. You're going to record every lien, and then you're going to make sure each lien was paid off. And you're checking those liens in the recorder's office, the clerk of court's office, probate, and then we run, or the current owner will run, bankruptcy. So we do that through Pacers.
Right. Make sure no one else is trying to make a claim to the property, anything kind of odd or weird. So on that topic, so one of the pieces that we always get a question about is owner's title insurance, right? So when we disclose these loans to these buyers up front, we're disclosing the title pieces, our piece, of course, owner's title insurance, which is an additional layer of protection for that buyer up front, which is an optional thing. But everybody's always asking, hey, what is it? So what do you think? What's the best way to explain that to that buyer?
Essentially, it's the only protection for the buyer, because in a loan transaction, cash purchase, everybody, there's no lender involved.
Right.
In a loan transaction, you're always getting a loan policy of title insurance. That ensures that you as a lender are in first and best lien position. Nobody takes priority over you. That has no protection for the buyer. So the buyer's risk is all depending upon how much money they put down. Most claims appear in the first 3 years.
Right.
So let's just say it's 100% buyer and there is a claim. And a claim would be where somebody makes a claim to the property, whether it be unpaid taxes, judgment lien, fraud, forgery, like somebody sold the property or signed on behalf of somebody that did not actually own the property, a unpaid mortgage, unpaid federal tax lien, just anything that can occur, and these can occur in so many different ways. So the more money you put down as a buyer, or the longer the term of that loan gets where you put more money into the property,
right,
that's
got
more risk.
That's where you're at.
That's where you have more risk. Okay. So as a buyer, you want to assess that. I mean, Me personally, just for the small cost that it's going to take, it's going to be just the comfort alone of knowing
Right.
that nobody can attack your property for a prior act.
Right. Which, I buy investment properties, right? So, and I usually am doing a large cash investment in those. So I always obtain it.
Oh,
Because,
100%.
when you're throwing a lot of money out there, that's your only protection, especially in the short run, right?
Right.
Whether it's long-term investment or you're doing a flip, you just got to have it just in case.
And depressed properties typically have more risk,
Right.
because you're
Mhm.
running into a
Foreclosed
situation
properties.
to where somebody's selling it to you at a discount for a reason. They're in financial trouble.
Specifically, USDA is what we're going to dive into today. So the reason I wanted to talk about this a little bit is there's a lot of misconceptions out there about what you can do with certain products, where you can buy, what the costs are, what's the out-of-pocket expense, things like that. So wanted to kind of put those to bed. So USDA is a very popular option here in my area, here in Shelby County. It is a rural-based program, but there's a lot of misconceptions with it. People think they need a large down payment, or they have to have like a 780 credit score, or hey, you can only buy that out in the country, or it's for farms. It's none of the above, right? Or all the above, you could say. So what we could do with USDA is a very neat program. It is rural in nature, but if you're watching this program, most likely you're watching it from the Shelby County area or maybe the closer surrounding areas. So Shelby County, Darke County, Auglaize County, Mercer County, Logan County, Champaign County, they're all 100% eligible for USDA financing, even in their micropolitan towns, right? So like here in Shelby County, we're in Sydney, and even in Sydney, you can use USDA financing. You don't have to be out in the country. Now, there is a USDA eligibility map where you cannot purchase your home, right? And you can take a look at that if this is a program that you're interested in. So USDA is a rural development program again, and the big benefits here are it's a no down payment mortgage, right? That's huge. In today's market, with what's going on and inflation and the cost of housing and everything that's happening, being able to go with a no down payment mortgage and some additional flexibility with that program is huge. It is huge. It's very flexible in regards to credit scores, down to about a 600. Some say you can go a little bit lower. I've tested that water, and sometimes that doesn't work out. Some will tell you, get over a 600 to go USDA financing. Again, no down payment. It's got very low PMI. The rates are very, very competitive. They're very, very similar to what you might see with an FHA mortgage. The nice thing about it also is you have the ability to finance some stuff into the program, right? So let's say you're out there negotiating on a home. Maybe the seller doesn't want to come off of the sales price or doesn't want to help cover with some closing cost expense. Well, you are allowed to finance that into your mortgage on USDA financing. However, you have to have enough appraised value. Right. So example, buying a house for $100,000, you need, I don't know, let's say $5,000 towards closing costs and prepaids, and you make your base loan amount 105. Well, the appraised value has to be at least 105 to make that work, right? Because you can only go up to 100% of the appraised value of the home or sales price of the home, whichever happens to be less in this case. Other nice, neat features to the USDA program is we have the ability to do a renovation loan attached to it as well. So if we run into some of these homes that might need a little bit of upkeep, but maybe the borrower can go with a conventional option, the USDA renovation is there as well. And it's fantastic because we can finance, again, up to the appraised value. When we do this, though, let's say, I always want to do examples so you can kind of grasp it a little easier. So let's say we need a new furnace, okay? So we're buying a house for $100,000. We get a furnace or an HVAC estimate for $8,000. We finance that into the loan. Now we're sitting at 108. Again, our appraised value has to be 108. Now the question becomes, well, just because we're doing this doesn't mean we're going to have enough value to do it. The big thing here is that the appraiser is actually going to get the estimate as well. So they're going to give us an after improved value, which may help us out a little bit. So that's always something to take into consideration when you're looking at some of these homes, and you might see a house that just needs a little bit of loving. Not a lot, all right, don't go crazy, but something, maybe some updating. You can go as far as, kitchen cabinets and even appliances, but we like to try to stick with the program with, hey, what's needed to get this house up to par, whether it's peeling paint or GFCI outlets or whatever it might be, but that has that flexibility. 5 things that you shouldn't do or shouldn't worry about or something along those lines for buyers when you're getting into the market to purchase your first home. A lot of people are always worried about misconceptions, what you should do, what you shouldn't do, the no's, the do's, the don'ts, all this fun stuff. So I wanted to touch on them, right? These are things that we talk to buyers about when we do their loan application. But, before you even jump into thinking about purchasing a home, it might be something that you want to consider or start making moves on to make sure we're not making any mistakes ahead of time, right? So let's talk about these. I got 5 things listed here that we should entertain or be thinking about when you're getting ready to purchase a home. So number 1, don't shop for a house without getting pre-approved, okay? This isn't just for me or yourself. This is also for your real estate agent, right? You call up an agent, you find a house online, you're like, hey, I want to go check this place out. First thing, please call your lender, right? Give us a shout, or whoever your buddy is that's doing your loan for you. Give them a call ahead of time. Let's start that process. We want to make sure the credit's there, right? We want to make sure the income's there. You're not falling in love with a house that you can't quite afford, or maybe it's in a certain area and you have to go with a certain loan program and you don't have the money for the down payment. We want to work these options out way ahead of the game before you dive into the market and you fall in love with something that you just can't quite make work, right? So that's number 1, right? Let's go ahead and call your lender. Let's get it pre-approved. No square peg round hole this stuff. We want to make sure you're prepared to go. Another question we get a lot on, and I'm sure you get it all the time because you're actually in insurance, but when it comes back, when we get a quote for a client, they're wondering and they're looking through their coverages, they're like, why the hell am I buying a $150,000 house, but my insurance coverage for $450,000? It's usually classic replacement cost, right? Yeah. That's the common question. But you would think common sense should apply to that situation. It doesn't always. So is there a calculation? Is there something how insurance companies are determining that information?
So what we do is when we get the property, we know the property address. So we're going to do research on what the house is like. What's the square footage? Is it 1 story, 2 story? Does it have a basement? Does it not have a basement? And we're going to plug all that information into a replacement cost estimator. And so all the carriers have one. They use several different carriers or several different companies. And so we plug that in. What's the square footage? Is it 1,700 square foot? Is it 2,200 square foot? Is it a 1 story, 2 story? Like I said, is it a Cape Cod style? Is it not? We go through all of that, and we're going to determine that's going to help us determine what the cost is to replace that house. Mm-hmm. And so when you buy a house, it may be older house downtown, but it has a lot of square footage with it. So what's the cost to replace that house as opposed to what the market value is? Those market values are typically a lot lower. Right. However, the replacement cost on that property is a lot higher. So you're talking, what we look at is in building costs right now is anywhere from $200 to $300 a square foot. Right. Well, if you look at a purchase price, it may not be that. It may be 100, 110. So if you let's take a 2,000 square foot house and the market value on it is only 175 for purchase. Right. We're going to probably insure that for $350. Right. And that's just how it is. And because we don't care about what it costs to buy it. With insurance, you're buying, what does it cost to replace it? Right. So if that house was a total loss at this point in time, right now, what do we have to spend to fix it and rebuild it if it was a complete loss? Right.
Yeah, and it's taken into account, custom builds, it's taken into account skilled labor, the cost of material, and which, obviously since COVID hit, we've seen go up dramatically, right? I mean, all the insurance companies across the board, not just homeowners insurance going up, but car insurance is going up because the length of time it's taking to fix cars, the availability of parts, and all this stuff, right? Everything. It's all gone up, and it's one of those things that that people don't think about when they're buying a house, or when the talking heads talk about how strong the economy is and inflation has been tamed, and it's only costing a few extra $1,000s a year for you to live in this inflation world. It's impacting everything
across the board,
and that's it for us this week. So remember, when you watch the video, like it, love it, share it with your friends, subscribe on YouTube. It's really easy. You just have to have an account and click that subscribe button. It doesn't cost you any money. And check us out on Spotify and Apple Podcasts, and we'll see you guys next week.